The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Hello and thanks for tuning into Your Money, Your Call. I'm Margaret Lomas. Welcome to the program for another great week in property. It is certainly great to have you on board as we head into the festive season. Tonight, a discussion around what people are looking for in property, and you might be surprised to see what's the driving factor is amongst younger buyers. We also take a look at the regional trends according to common research reports. Now, in order to get as much great information to you as possible, Noel Petrohelos from BMT and Simon Pressley from Propertyology, who are experts in all of our topics tonight, are here and standing by for your questions and also to listen to your comments. So get those questions ready to go and be sure you send them to me now, or better still, give us a call. You can have them answered three ways: with a call to 1300 30 34 35, a tweet to me at Margaret Lomas AU with the hashtag YMYC, or an email to property@skynews.com.au. And while we wait for your calls, here's some news for discussion. And prospective home buyers and those looking to rent properties are increasingly concerned with the type of internet connection that the house has, with some willing to pay a premium for NBN fibre to the home. One of the criticisms of the multi-technology mix employed by the NBN rollout is the fact that it is creating a digital divide, depending on what access technology your home uses to connect to the network. As a result, those seeking to rent or buy real estate, particularly among the younger generation, are seeking out suburbs and homes catered to by the best technology. Real estate agent Joe Recep says that a very, very common question is the home NBN connected? With the next question being, is it connected to fibre to the premises or is it fibre to the node? He said the question around the type of internet connection has become a top concern for buyers among traditional queries about the nearest bus stop and what school zone the property falls into. With a lot of people working from home nowadays, it is really an essential rather than just a want. Homes are already connected to the NBN sell much quicker than those still waiting for the rollout. Welcome to the program and welcome to you both.
Thanks, Margaret.
Thanks, Margaret.
Good to be here.
An interesting piece, Noel. I know you sent this one over for me.
I did. I sent it over.
And you know what? I'm in agreement with that, because I have fibre to the node, not fibre to the premises, and it is annoying. I was trying to watch something the other night just off my computer that I have connected to the TV.
And if it's failing?
Quite legal, of course. And it's probably every 2 minutes, it was stopping and buffering and waiting, and it was so annoying that I couldn't watch it in the end. Not to mention what it's like for me when I am trying to work, and all day it's dropping out if I choose to work from home.
When I first saw this article, I found it a little bit humorous at first, but it's the little things that we don't think of sometimes. As an investor myself, I've never really thought about that. But after reading this, I know that if I got a complaint about the internet not being good enough at one of my properties, I'd be seriously considering and taking it seriously. For an agent to say it's one of the top things that they're being asked, I mean, we're going into we've been in the tech era for a long time, but it is so important to this generation. But not only that, businesses operating from home. It's become a trend that I think is important to so many people to have good quality internet. And the fact that it's something that's asked like that as a top question, I think really good to know for investors.
It certainly is. Do you think, Simon, that this could ultimately, over time, impact on different areas and property price growth in different areas? Obviously, we need to cater for tenant demand, but is this such a big factor?
It could become a big factor, certainly if there over time becomes renowned pockets that just have really, really poor internet connection and low speed. We're in the digital world, that's not going away. We're going to become more and more dependent on it. So it could become an issue, as I said, in isolated pockets. So I'd like to think that people aren't sort of paying a massive premium for buying an individual home based wholly and solely on the internet, but it's certainly really important.
Do you think they'd be paying a premium on rent though? Certainly if you could get residential premises with fibre to the premises, I wonder if that's worth $10 or $15 a week more to you.
Possibly, and I could imagine a lot of tenants, you know, it being one of their must-haves on their questions. If they're in a market, they're out of lease and vacancy rates are high, and you've got lots of properties to pick from, and you rely on the internet a lot, which is all of us these days, certainly.
I know that I definitely would be paying that premium if I knew I could get that kind of a service, just for my own mental well-being. You know, it drives me mad at the moment I can't tell you how much stress I feel with the internet dropping out all of the time. If I was a renter and I thought I could get somewhere with, you know, really good fast internet, I reckon I'd be paying that extra.
It is a little, I mean, it's a little thing, and as Simon said, it could be the game changer. And if there's a lot of similar properties around and it's something that's being advertised, I mean, if I do have great NBN and fibre to the door at one of my places, I want my property manager to put it in there.
Yeah.
If that's important to people, you know, it's a supply and demand thing, isn't it?
Absolutely.
Let's just add this to the growing list of government stuff-ups. We've spent $50 billion in the digital age, and we still can't get internet right. And both Liberal and Labor have had their fingers in this.
Now, Simon, we only have a 1-hour program. And so get me started on
Where do we go? Where do we start?
We don't need it tonight. Let's go to the phones instead. And Nick from Sydney. How are you going, Nick? Hello, Nick.
Hi, Margaret. How are you?
Pretty good. How are you going? What can we do for you tonight?
Not to you. I just wanted to ask, I have a property in Narrandera regional town, and it's an older property, housing commission, and it's pretty tired. I'm looking at renovating to improve my rental, and opposite, a fellow bought a 1,000-metre square block. He's put 3 townhouses, quite nice, and it's up the street at the moment. Now, I'm looking at maybe doing, you know, putting a fence and doing a paint job and that. I'm also thinking about a granny flat as well. Am I thinking a bit too much on that?
All right, so you're thinking of both renovating the property in Narrandera and adding a granny flat to behind it?
Yes.
Okay. Simon, what do you think?
Oh, firstly, Narrandera. Well done, Nick. That's a really thinking outside the square location, and a good one, in my view. But look, that demographic out there where land is affordable, housing is affordable, I'd be sticking with the detached dwelling and be cautious about you know, going really small dwellings on a large block. I don't think there's a lot of demand for that style of dwelling out there, given how affordable housing is.
Not yet, there isn't, absolutely, and you make a good point. People have to be careful about making sure that they're providing the right style of property for the demographic demand, and we usually don't see areas like Narrandera turning into an area where there's a lot of units or townhouses until we start to get a real stress on the land that's available. Still plenty of land out that way.
Absolutely, and especially the granny flat. I wouldn't be doing that at all. Yeah.
You don't think there's going to be demand for granny flat out that way?
No way, no. You're looking for that one-off buyer to buy a very specialised dwelling. It could actually work against you, I think, doing that.
Although it could improve the income, if that's what he's after, if he's wanting to hold.
If you can find an occupant who wants the 2 dwellings, you know, and there may not be that sort of demand there.
Or a different rental in the front than behind.
Possibly.
So, yeah, so 2 rentals. In terms of the ability to be able to create extra income, definitely people do find that. Look, I think we're going to talk about this a bit later on in the show, but from a depreciation point of view with the new rules now, if he does add that granny flat, he's going to get a really big bucket load of depreciation.
He gets extra depreciation because it's a new construction for the new owner. So from the granny flat point of view and a tax position, it's quite good. I mean, we do lots of granny flats all over Australia, and the average build is about 120 to 150. They return about that 15 grand a year, so the yield's really strong. As long as Simon said, the area suits it. One good thing, I guess, and I think Nick's pretty spot on, and he's really hit the nail on the head, renovating that existing place, generating that value straight away. A granny flat at the back, it may not be ready for that yet, but as land gets, as the land shortage becomes apparent in the area over years to come, then it might be a time to either do the triplex or the granny flat out the back. But the renovation at the front as well, same with depreciation, because he's putting new assets into the property, he can claim those assets, whereas if the property if he acquires under current new rules, the existing assets, because they're second hand, he can't claim the plant and equipment component. And being just the sounds of that property being the age that it probably is probably built prior to 1987, so there won't be a whole heap of building write-off as well. So it sounds like he's doing the right thing from that, adding a bit of value from a tax perspective, and in the right area as well.
Yeah, look, Nick, just a couple of things. The panel seem to agree that renovating it is probably a good idea. I guess if you are planning to hold this property for the longer term rather than the shorter term, then certainly being able to put a granny flat in the back, subject to how big it is. I think a granny flat development can work if the block is big enough that both parties still get a yard. I think where it's stuck right up against almost the back wall of the existing property, that can be a mistake. But if you're going to get a bit of a yard, and I've seen them done well, then you can definitely boost up the income that will help you pay off the property sooner, get equity sooner, to help you leverage into more property sooner, and therefore grow a stronger base of properties more quickly. But if you were considering selling at any time in the shorter term, you might then, as Simon has suggested, detract from the attractiveness of that property to new buyers. I'd suggest that we have probably at this point in time more owner-occupiers, considerably so, than we do renters, and therefore it'll be the owner-occupier market that will push the value up. If, on the other hand, it's a pure investment for you that you plan to keep ad infinitum, and there are no plans necessarily for you to sell it in the foreseeable future, it's probably a gamble that I would definitely consider taking, as long as it can be done right, and as long as you can create that good private open space for each party, and make it look more like two separate dwellings. One other thing, if it is an older property and you haven't had a depreciation report done, once you've done the renovations, or even beforehand, maybe talk to the guys over at BMT, where Noel's from, because even an older property will have to have some new things in it.
Yeah.
And when I say new, I don't mean brand new. The carpet's probably been replaced at some time. The hot water heater most likely has also been replaced at some point in time. So it's definitely worthwhile you getting someone to have a look, because if you're renovating, you might be throwing out a whole pile of stuff that still has a bit of residual value, as long as you've settled on that property before May 9 this year, or exchanged contracts on it before May 9 this year, which I'd suggest that you probably did. Get a value put on any item that you're going to be throwing out, because it is 100% deductible in the year that you get rid of it, and you might well be getting rid of some things with a small amount of residual value in that year.
That's right, and the same goes for the Division 43 building write-off component. So even if there's been a new kitchen or a pergola or something that they rip out, they can claim what's left in that building write-off as well. So it's well worth having a chat with a specialist QS first.
Definitely well worth it. You can get back enough of your tax sometimes to pay a little bit of those renovations.
Oh, definitely, definitely.
Well, you're watching Your Money, Your Call, and we're talking all things property, which means that you get the chance to have your question answered by an expert, and also be rewarded for doing so in more ways than just getting the answer. Call, email or tweet your question to us, and if we do answer it tonight on the show, you will score a copy of one of my 8 books. Now this week it is How to Achieve Property Success. This is a great book about every step of the investing process. Call now on 1300 30 34 35. Tweet me at Margaret Lomas AU with the hashtag YMYC, or email property@skynews.com.au with your question. And if we answer it tonight, make sure that you watch at the end of the show to see how you can get hold of your copy. Now, after this short break, we have a few more questions to answer, and also some news about the regional areas to watch in 2018. So be sure to stay right where you are, and we'll be right back.
You're watching Your Money, Your Call on Sky News Business.
Welcome back. It's always a pleasure to be hosting the show and bringing you your weekly dose of property education. Noel Petrohelos from BMT and Simon Pressley from Propertyology have come along to the studio specifically to answer your questions, so be sure to get them to us now, either on 1300 30 34 35, via a tweet to Margaret Lomas AU with the hashtag YMYC, or an email to property@skynews.com.au. Now, we do have an email waiting to be answered, and this one is regarding data and reports, and is from Tony, who asks, "Hi, and it's great watching your show. Thank you. Are you able to assist with which is the best property prediction report to buy?" Well, Simon, I always worry a little. I think you know my feelings about property prediction reports, and generally when anybody is putting together a report, very few of them are really based on significant future data or the access to future information about an area, and many of them are based on past information.
Many of them are, and look, no one should be making any decision as important as investing in property based on one report. It's really important to understand who the author is, what the author's qualifications are. Every bank in the land will produce a property market outlook report, and they're probably not worth the paper they're written on.
Well, I've got to say, I read them every quarter, and not only are they all different, but I've taken great delight more recently in going back to ones from a quarter ago or even a year ago, and see how inaccurate they all are.
Yeah.
Because they're basically economists' view based on past data extrapolated out for the future.
Yeah, and it's important to understand what's the author's core business. So a bank and an economist, for example, have to have a general understanding of all sorts of stuff, you know, commodity prices, interest rates, currency rates, all sorts of things. It's a bit like our GP versus specialist in the medical profession. So, make sure that the author is someone who actually analyses property markets day in, day out. But even then, what's in the report? Each year, Propertyology, for example, will do a property market outlook report, but we're not saying where you should or shouldn't buy. We're just saying this is what we think might happen in the capital cities for next year.
Although sometimes it's pretty clear where you shouldn't buy.
Well, definitely if someone's saying we forecast it's going to go backwards, you shouldn't be buying there.
Yeah, it's sometimes clear. Is there anything you like? Are there reports you like to use, not?
Not one in particular. When I do my research, I look at a lot of stuff that's available on the net. I think the important thing, and the mistake people make, is look at one particular document that might be focused overarching on a region or a town, or looking at Sydney or Melbourne, and you just, as soon as I start reading some of those things, I take a step back and think, wow, how are these people analysing that market as a whole? I've seen reports looking at New South Wales versus Queensland.
Yeah, that's ridiculous.
It's ridiculous, because some of the markets that are sitting within markets and within other markets are small, and the ones that I like are ones that are looking at particular suburbs and the drivers that are surrounding. And you might be looking at a suburb that's next door to a suburb that's doing really well, and a stone's throw away is struggling for some reason, but that area is feeding off the same economic drivers. And experts like yourself looking at regional areas and focusing in on some of those and delving in on some of those numbers for that particular part of that regional area, I really like.
Or even a particular part of a capital city. It's definitely not unusual for a capital city to be reporting negative data for a quarter, for example, Melbourne, and still find that there's a pocket in there which has been really gunning along for that same quarter, and the figures are just lost.
And outperforming everywhere else.
Yeah.
And
people miss it because they just listen to that one figure.
Yeah, and look, that's the thing I'd just be careful of. Look, it's do your research, look around, and jump on forums and have a listen to what people are saying about other reports.
Yeah,
usually hear a bit.
Well, on the same vein, I've always known this, and now Terry Ryder does tell us that one of the prevailing myths in residential real estate is that you should always buy in the capital cities because regional centres can't match the big cities on capital growth. Well, he says it's rubbish, and I tend to agree. The myth is supported by research companies which specialise in trying to encapsulate an entire nation or a very large region in a single growth figure. In a recent recent example, it has been reported that dwelling values have grown 7% in the combined capital cities in the past 12 months, but the combined regional areas have only grown 5%. But like all generalisations about Australian real estate, the figures are really meaningless and essentially useless. The 7% growth figure for the capital cities doesn't tell us anything useful because it disguises two cities where values have fallen, two where values have grown very little, a couple with solid growth and a couple with really strong growth. Now, it's much more useful to look at individual markets, some of which blow away the myth about regional markets underperforming. And it is true, and you know, everybody knows that in the past I've been a fan of the regions, and then I've been through a period of time where not so. And that has got nothing to do with whether one minute I happen to like the regions or the next minute I don't like them anymore, and more to do with the fact that when timing is concerned, there are times when the regions really perform very well, and there are times when, okay, now's maybe not the time to invest in them.
Look, no two regions are the same as no two capital cities are the same. Perth and Darwin have had 3 years of decline. In those same 3 years, Sydney and Melbourne were really strong. We can say the same about all the regions all across Australia. Without exception, every single year, there will be lots of regional locations that have performed really well. We just won't read about them in the media. Goondiwindi grew by 30% in the last 3 years. Guyra grew by 50% in the last 3 years. I mean, they're probably two stats that people have never heard of, but they're facts. 1 in 3.
Everyone's heard of Goondiwindi, come on.
But have they heard of the price growth? 1 in 3 Australians live in regional Australia, so we're not talking an insignificant number.
Yeah, exactly.
There are 139 local government councils across our 8 capital cities, but there are 411 local councils across regional Australia. The single strongest industry over the last 12 months has been our agricultural sector. Not too many farms in our capital cities. And it's not just a matter of picking a region that's got farming, it's actually thinking about, well, where do they manufacture the produce, because the jobs are in the factory. Our tourism sector's strong. Regional airports are growing significantly. We're huge fans of regional Australia. I think I've got more properties in my portfolio that are regional locations in capital cities.
I definitely did in the beginning because, you know, when you were still a boy probably in school and I was originally investing, it was...
Margaret and I were investing.
It was a similar, I think I've got a few years on you as well. It was a similar situation where the regions were doing really well and I was investing fairly heavily in some of those regions and have really been the beneficiary of some really good results as a result of that decision to do so at a time when nobody else was doing it. And then for a while there, they sat a little bit flat and some regions were a little oversold. And at that time, a lot of the outer suburbs of the capital cities, which a lot of the people in the cities consider to be almost regional, were doing very well then. And I was obviously able to buy in some of those too. I have some properties that are in very close to CBDs as well. But I can't say that over a time period that any of those have outperformed any of my other properties. I think I've had some pretty damn good growth across all of them.
And the yield is often forgotten about regional cities. I mean, we typically would pay between $250,000 and $450,000 for a detached house, not a dollar more. Yields between 5 and 6.5%. Affordability is going to be a major driver of the best performing markets in future years. There's roughly 20,000 people that left Sydney last year. Mostly because of affordability.
Absolutely. One of the things about the regions, though, I think to be wary of, Noel, is that there are some examples of the bigger regional centres where the developers get in before the investors, buy up the broadacre lots, develop them, and then oversell as well with prices that are just too high for what that area, for the intrinsic value. I believe we saw it happen in Ballarat and Bendigo, where really there was not so much a two-speed market, but a two-price market. Established houses were being sold significantly cheaper than all the brand new stock, but once they settle and they're a year or two down the track, then that gap closes with, unfortunately, that new stock coming back down. And I think people have lost some money in some of those bigger areas as a result of that.
People, they've got to be careful if you get caught up in the hype of that brand new property and you go and have a look and, you know, there's I guess, blocks after blocks after block of very similar type builds, and there's still available land and acreage nearby, and developers are snapping them up one after the other, then you do need to be careful, definitely. But a lot of this, and I think Terry's hit the nail on the head, the media behind this drive with capital cities is a little bit ridiculous. I'm not saying capital cities aren't a good place to invest, because as we said before, there's pockets that are fantastic, but there's so many regional areas that tick away over time, and the media love this hype around a spike, a big spike over a short period of time.
Unfortunately, a boom like we've had in Sydney recently doesn't do anyone any favours.
It doesn't.
Because it leads to very short memories and an expectation that if you're going to buy property, it should be performing like that.
Yeah.
And I think I must have said it on this show at least a dozen times now, but please don't forget that between 2003 and 2010, when every other capital city almost doubled in value, Sydney only gained 17% across the entire 7 years. And for those people whose timing was that they bought in 2003 or just prior and were ready to sell at 2010 or just after, they didn't make any money, and they were blaming everything. They were blaming the government, they were blaming New South Wales, they were blaming everything, and New South Wales wasn't the place to buy in. Now, our memories are so short, and I suspect we're going to go through another protracted period like that right now. The good news story isn't that capital cities always grow. There's always a section in time where they will, and then a section in time where they won't, and overall it all comes out in the wash. So just be very careful about how you approach property investing. Coming up next is a question about investing in towns which have crashed. But right now we need to go to another break, but we will be back soon. If you do have a question for us, call to join the queue on 1300 30 34 35. Tweet me to Margaret Lomas AU with the hashtag YMYC, or email property@skynews.com.au. We'll be right back soon with more of the show.
You're watching Your Money, Your Call on Australia's Business Channel.
Welcome back, and thanks for tuning in tonight for our property edition of Your Money, Your Call. I'm Margaret Lomas from Destiny Financial Solutions, and tonight Noel Petrohelos from BMT and Simon Pressley from Propertyology are answering your questions. So please call us now on 1300 30 34 35, tweet Margaret Lomas AU, or you can email us on property@skynews.com.au. And remember, every question answered on the show tonight will receive a copy of my book valued at $40 just for having it answered on the show, so please do call us right now. Joshua wants some advice before taking the plunge, and he asks, I'm looking to develop 4 strata homes on land that I own in Maryland's New South Wales. I'm looking to have it completed by the end of 2018. With interest rates looking likely to increase around that time, will the whole market take a hit, or is the Parramatta area's growth prospects strong enough not to be impacted as much? Well, you know, Noel, I've been watching the interest rate futures for the last year.
Yeah.
And every quarter when I look at them again, it's the same curve pushed out. Now, to explain to viewers, the interest rate futures is by no means an accurate barometer of where interest rates are going to go, but what it is it's the market opinion of experienced traders who trade interest rate futures, and at this point in time the expectation of that rise is being pushed out all the time, and now looks like it's been pushed out right until 2019.
Yeah,
now.
that's the latest.
Yeah, that's the latest.
So I mean, personally, in this scenario, I think looking at interest rates is the only thing, and especially being a small development like this, there's no doubt that he's potentially doing a small development in a cooling market, but really all he's got to do is be conservative with his feasibility study and make sure that it still stacks. Like any good feasibility study, you should have your optimistic, your pessimistic and your realistic. Yep. Make sure it still stacks with your conservative, pessimistic option. And look, if he's doing his numbers as a development, then really it's based on the acquisition of the land, your construction cost, your hurdle as a developer, you know, your builder's margins, and then if it stacks in that conservative pricing, then go for it. I wouldn't be sitting there worried about what's going to happen with interest rates in 2018. Me personally, they could change, little disclaimer, but
yes.
Yeah.
I guess there's a lot of things to consider when you are going to do a development over and above just whether or not the area is going to continue to grow.
Oh, there's dozens of factors that affect property markets, as we know, when interest rates are one. Look, if anything, in regards to the comment about, Parramatta's too strong of a market to be affected, if anything, Sydney will be affected more when rates rise than anywhere else in Australia, because the mortgages are the biggest. But
I think he's picking out Parramatta as distinct from Sydney, being that, in Sydney now it is considered that Sydney, Liverpool and Parramatta are three separate cities that tend to behave differently from each other. Parramatta has a lot of strengths going for it at the moment, but whether or not it will, I think he's hoping that it bucks the trend. The cooling trend.
The two things I'd be most cautious about here, one of the points that Noel made, we're at the end of Sydney's growth cycle, so starting a project
and that
now...
includes Parramatta.
Absolutely it does.
Yeah.
Starting a project now and finishing it in, say, 2 years' time, I'd be factoring in with your feasibility the potential that whatever you'd sell that completed property for today, are you going to make a profit if you sold it for, say, 10, 15% less? Now, I'm not saying Sydney will fall by 10 to 15%, but there is that potential. And supply is the other consideration. Parramatta historically built about 1,500 new dwellings a year. The last 3 years, that's 2,500. Sydney historically builds 25,000 properties a year. The last 3 years, there's been 50,000 a year built. This is yet to flush through the system. So when we've got the APRA credit tightening combined with a lot of supply going to hit the market next couple of years.
It is a little bit of a worry. Yeah. Joshua, there's just so many things that you need to be considering here, and there's things on the upside as well as on the downside as far as I'm concerned. If you can if you're going to hold them and not sell them, and you're going to carry out a development where at the end of the day your costs are covered but maybe your cash flow increases, it could be a good idea. If I can just give you a really quick example, I had a duplex down in Adelaide that I tore down and I did 4. In fact, I had 2 of them, 2 duplexes, and I replaced them with 8. Now, there was not a lot of growth in the market that those duplexes were in, but what I actually got, I was only getting $140 a week rent return on each duplex half, and now I'm getting $280 on each new unit, so I've quadrupled my cash flow, but the bottom line was that my costs didn't quadruple. So my costs doubled, but my income quadrupled, and it's made it worthwhile doing it even if I didn't get any growth for now, because I intend to hold them and I'm going to hold them over time, and I can now very comfortably hold and wait till that growth comes, which I think will be in about 5 years' time. If the same thing applies to you, if you can hold through the next 7-year period of flattening or even downturn and get a really good cash flow and cover out all your costs on the most pessimistic scenario, it could be something to think about going ahead with. I wouldn't be going ahead necessarily with the project if you're doing it purely because you think you'll have 4 times the exposure in the market that will then continue to grow and you'll get 4 times the growth, because I think the panel all agrees that your most likely scenario is that you're not going to see as good a growth. So many things to think about. I don't think Parramatta will be accepted from the slowdown across Sydney. Simon has some very good points about supply, and it's very important for you to think about those. Well, Daniel is looking to Melbourne to buy, and he asks, hi panel, what does the panel think of Emerald in Central Queensland? Okay, so he's not actually looking to Melbourne to buy at all. He's looking at Emerald in Central Queensland, nowhere near Melbourne, but anyway. I just purchased a property there 3 months ago for $99,000 from a bank. It's renting out for $170 a week. Now, I'm not sure what you're going to say, because you and I haven't talked about this, but I'm going to tell you what I think. People often are attracted to the fact that they can buy a property for $99,000 or $100,000, get $170 a week, and yay, this is fabulous cash flow. Yeah. But underneath that, if all that happens is after 5 years or 10 years you end up with a property that is worth the same amount of money and you're still getting the same rent, it's a nil-sum game. You haven't moved off square one. And the cheapness of the property and the good cash flow, sure, the cash flow might help to pay it off, but you might get 20 or 30 or 40,000 equity in it. But that same money in a better market may have actually compounded that growth and given you a better bottom line. My first comment to this answer to this question is, young players at home, don't go anywhere near a market like this. But look, we don't know this viewer's scenario. Yeah. He might own several properties already. And I'd suggest for someone who's paid $99,000 for a property,
there's actually very little risk in that, even though you're talking central Queensland.
Unless you can't afford to lose $99,000.
Yeah, that's an issue. But 13,000 people out in the middle of nowhere, really. But it could actually be a really good winner. It's very close to the very controversial Adani coal mine, but more importantly, put Adani to the side, the Galilee Basin is the world's biggest reserve of coal. We're going to need more and more energy as population continues to grow. So it may be a major winner. We certainly know it's going to be cash flow positive with those sort of numbers, but his 99 grand could become $300,000 or $400,000. That market did peak at 450,000, by the way, in 2012.
I was going to say, Noel, that he probably purchased this off someone who bought it for 400,000, who probably bought it off someone for 99,000, and someone wrote it up, and then probably then got greedy and said yay, because at 400,000 they're probably all thinking it's going to do a Karratha or a, you know, one of those areas and go to $1 million for a donga, basically. That always sounds rude when I say that, but they all think it's going to go to $1 million. So at 400,000 he probably was still riding it up when it turned, and then he probably thought, oh, it's temporary, and he waited, and it's probably gone down to 99,000.
He's written it down again.
The guy in the middle is the guy who's lost, really.
I think in excess of 50% of the properties in Emerald are flood prone, and you probably won't get any insurance on it. So let's hope this property isn't one of those properties. There's one part of town that floods heavily all the time.
Yeah, okay.
Look, I would like to just suggest to you that if it does look like it turns the corner, I would, just as you would with shares, set almost like a stop loss in reverse. So ask yourself what price you'd like to see it get to when you're prepared to sell, and it might be 250,000, and sell and take your money at 250,000, and then if it grows from there, so be it. But just be aware that the person who you bought it from, or perhaps the person prior to that, most likely had a really good opportunity at 400,000 to make some good money and didn't take it, or maybe they did and sold it to the person who then ended up with it being worth 99,000. The moral and bottom line of this story is areas like Emerald behave more like a share portfolio than they do a property portfolio, albeit it takes a little longer to go up and down, but it still happens a lot more quickly than it does in a normal property market, and it falls much further. A good, solid, stable market will never fall by 75% in the space of a year, which is essentially what's happened here. So you are in a risky market. Good luck to you. It's not something I recommend for the faint-hearted. We do have an email from Michael, and Michael says, "Hi Margaret, I have an investment property in Orange. I've owned it for 3 years and it's an old property. I was wondering if I should get a depreciation schedule. Is it worthwhile?" Is it worthwhile? No. It's
definitely worthwhile having a chat with us. You've owned it for 3 years. It's worthwhile. He's bought it 3 years ago, so he's bought it prior to the May 9 budget changes in 2017. He's likely not budget affected. The only thing that would change that is if he has lived in it for a little while. If he's lived in that property for a little while, then the assets, the plant and equipment assets, are deemed previously used.
You know what? I found out last week from Julia Hartman, who was on this very panel, that if you own a property, say this one in Orange, and if he went up there for a week to renovate it and lived in it, she claims that the tax office, you know what she's like with the tax office, she's very harsh with the tax office.
So when Treasury brought out this new legislation, they said okay to occasional use, and they did not quantify it. So she reckons that's 1 or 2 nights. Technically, she's right. However, there is a little carving out of occasional use. Now, the ATO have left that not the ATO, Treasury have left that fairly open. Now it's up to the ATO to administer, and there's going to be all sorts of cases and things put forward for this occasional use.
Surely, isn't it? Surely, if you go to a property, though, I mean, she used the example of a property that someone went to renovate. A fellow emailed in last week and wanted to go and renovate his holiday property. And she said, you're better off staying in a motel while you renovate. Look,
for a renovation that's going to take 3 or 4 weeks, to be safe, I would say don't stay there.
But surely you can say to the tax office, come on, guys. Obviously, it wasn't personal use. I was just saving money. By staying there. Come on, the tax office.
Everything's very black and white with them. And I would say, you know, camp in the backyard.
I'd love the tax
So
office.
stay in a hotel where you're doing the renovation, but then we're going to claim the deduction of a
That's right.
accommodation. So the
Yeah.
tax office is going
Well,
to
But you can't because they've got rid of the travel.
They,
so,
yeah, they have.
yeah.
And I know the
not a
tax
work
office is
expense.
reasonable. I'd love someone from the tax office to ring in to the program and say one night, we're actually a little bit more reasonable. There's a bit more room to move, and every
Yeah,
now and
look.
then we'll consider your individual personal circumstances and we'll find in favour of you. I reckon they would.
And I think they would too. And look, if this occasional use thing, if you say you're going there now and then, and that there hasn't been a whole heap of examples given, I think they'd be fine. But assuming that he hasn't lived in it for a period of time, I think, you know, Michael, you're pretty safe. You need a depreciation schedule, get it sorted straight away. He does say it's a bit of an older property, but I'm telling you, like, even if it was built 50, 60 years ago, there's a good chance that there's been some money spent on it in the last 10 or 15 years.
Plus,
and we'll find it.
You guys will tell him over the phone as well. You'll ask him some questions.
We will.
Before you trek out in your Corolla out to Orange, won't you?
There's the BMT Corollas everywhere, aren't
I know
they?
there is. I've been told about the BMT Corolla.
But yeah,
we'll
ask a few questions, make sure it's worthwhile. And look, even if we go out there and it turns out that it's not, we've got a guarantee there that makes sure that the client's covered. So we're not going to charge them unless we can make some money for them.
Sounds like a bargain to me. I think you should go for it. Much more still to come, but we do have a few messages for you. When we come back, you'll have another chance to get hold of a copy of my book, How to Achieve Property Success. You will have to ask a question and have it answered tonight. If you like the sound of that, then call 1300 30 34 35. Tweet Margaret Lomas AU with the hashtag YMYC, or you can also email us on property@skynews.com.au. We'll be right back here soon with more.
You're watching Your Money, Your Call on Sky News Business.
Welcome back to Your Money, Your Call. I'm Margaret Lomas from Destiny, and I've been fortunate enough to have on the panel tonight long-time regulars Noel Petrohelos from BMT and Simon Pressley from Propertyology. Our lines are closed for tonight, but we do have time for these last questions, starting with you, Sam from Melbourne. How can we help you?
Hi, Margaret. I'd just like to get the panel's views on Cottesloe in WA. I purchased a property there in 2010 for about 1.7 million, and it's worth about 2 million, but it's had a really strong run-up in the last 6 months, and I'm just wondering whether the panel takes a view on the long-term position of Cottesloe.
Now, it might interest you to know, Simon, that my wedding was at Cottesloe.
Beautiful part of the world.
Yeah, the old Cottesloe Hotel down on the beach there. They had a lovely little area upstairs where my husband and I got married 25 years ago in 2 weeks.
Congratulations.
Thank you. So what do you think of Cottesloe in terms of the investment potential?
It's not a place I'd be rushing out to invest in today, but Sam's already in the market. Look, it's been a lean few years in Perth. Our forecast for it is the market has bottomed, but is likely to plateau. Now, for how long, we don't know. There are still a lot of properties for sale. The vacancy rates are still, depending on which part of Perth we're talking about, but between 5% and 9%. It's going to take some time still to absorb that stock before we get any price growth. Long term, Perth is a wonderful city with good fundamentals.
I guess, you know, there's a whole lot of stuff going on here, Noel, and there are certainly some very small pockets of Perth that are reducing days on market and getting some demand going for them.
Yeah, in the last little bit, there's sort of
specifically the parts that go pretty much from Burswood out through to the airport, through Ascot. You know, there's all that really nice development along the river there that used to be just real swampland, and we're seeing a lot of trendy kind of cafes springing up. It's turned from very much, not so much an industrial, but a real retail precinct into a lot more of a nice place to be, some nice walkways and all sorts of stuff being done. But that's also property that is in the lower end of the market, under the 500,000 range.
That's right, and that's the point I was just about to make. It in these some of these areas for investment stock, I think it's too many eggs in one basket for me. Going in at 1.72 million sort of stuff, I'd be targeting those areas that are changing their face, that you can get in under $500,000. Going from industrial to trendy, we've seen, you know, there's dozens of suburbs in all the capital cities that we've seen take on that change and just see a spike. They perform really well.
Yeah, absolutely. Look, I think one of the issues that you have here is that you bought into a market in Perth that is very, very well regarded, very much owner-occupier, not so much renters, and as a result the yield is quite low. I'd be surprised if you were getting anything above 3% and maybe a little under that in terms of yield, which is not too much of a hit at the moment while interest rates are low, but if they go up it's going to hurt you to stay in that market. And when this market does recover, and I agree with Simon in that I can't see it happening in the next little while. You know, Perth overheated, it almost tripled in value about 9 years ago, and it's still really copping the brunt of that now. I think there'll be a protracted period of stability, and the properties that will grow will be the ones just like I spoke of then around Ascot and some of those cheaper markets, maybe down south and north, up around Clarkson, up into Yanchep, where we are seeing a population in Yanchep set to, I think it's rise by 400% in the next 10 years, a figure somewhere around that. They're those affordable markets that also have a much better yield, closer to 4.5%, sometimes 5%, and I think that's where the recovery will begin. And I don't know, I hope I'm wrong for you, but I think Cottesloe, beautiful as it is and well located as it is, I think you're going to be looking at quite some time before you get too much more in growth, and it's probably going to hurt hanging on for it in terms of that yield. Let's go to Jeff's email, who says, now that the government has changed the depreciation on plant and equipment, do you see the granny flat option becoming more popular in the right areas? And if possible, could you give us a rough figure when it comes to depreciation on granny flats for the first 5 years? Hopefully you've got this right at the tip of your fingers.
Of course I do, Margaret. It's my game.
It's your job. I'd be disappointed if you didn't.
Yeah, fundamentally, look, the granny flat's going to become a little bit more attractive option because it's a new build, and therefore all full depreciation entitlements are there,
I reckon you're
available.
Right. Yeah.
So it does become an attractive option, as opposed to then putting money into a second-hand property, which just sort of defies the purpose of what the government were trying to achieve in a lot of ways, because the private sector is funding a lot of these second-hand properties in lower socioeconomic areas. But they're potentially going to just chuck a granny flat on the back instead of buying that second-hand property. I won't get into that because we haven't got time. But basically, over the first 5 years, they'll average somewhere between $5,000 and $7,000 per year of extra deduction for the depreciation of the plant and equipment and the building write-off. Average granny flat we're seeing from 120 to 150,000.
So that's
achieving those kind of dollars.
About $7,500 in interest. Not a lot of additional costs because you don't have rates and all those sorts of things.
Yep.
Maybe some management costs, maybe 10,000, 7,000 in deductions, plus the income of roughly about 15 grand a year.
Yep.
You're way ahead.
Way ahead. You're looking at about a 15% yield, and like after tax, it's very, very, very cash flow positive and a great little scenario, so long as it's in the right area for granny flats.
Sounds like a great plan, and that is a wrap for this week. Now, I would like to thank my guests Simon and Noel for coming in this week. Next week, Steve Waters and Ian Rodriguez will be appearing on the show, so be sure to tune in again then. And of course, thanks to all of our callers, tweeters and emailers. If we answered your question on the show tonight, email me right now on yourmoneyyourcall@destiny.com.au. It is not there on the screen, so you can't see there, but it is yourmoneyyourcall@destiny.com.au. That may end up getting strapped across the bottom of the screen. But if you do email me at that email, tell me the question that you asked and provide me, no, it's not property@skynews.com.au. Please don't write into there yourmoneyyourcall@destiny.com.au. Tell me which question you asked and provide me with your mailing address, and I will send you your book. Now you want to read that viz that just went away, and that tells you where you can contact me between shows: Twitter at Margaret Lomas AU, Instagram at Margaret Lomas Property, or via my website destiny.com.au, where you can also get some great educational content, podcasts and video blogs. They're free of charge and a must watch if you're looking to build a property investment portfolio. Have a great week, and I'll see you right back here next week.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.